So we'll try again. It's 1:46 now. And we have a great Tuesday technology session for you with Benjamin J. Vann and Al Nolan from Bottle Rocket is here with us. They're going to do like a fireside chat. So a lot of you guys watched that inspirational session that just happened with our tech folks who talked about their businesses, startups, and dreams. And so Benjamin is the man with the plan who can tell you how to get these startups, these companies that you're building, these ideas that are in your head funded. So I'm going to back out of this conversation because it's way over my pay grade, and I'm going to let Al and Ben take it over.
Adrian, it's people like you that keep this whole industry going. So
thank you.
Like you don't have a part in this.
Goodbye.
All right. So as Adrian mentioned, Al Nolan, I'm a head of solution architecture for a company called Bottle Rocket in Dallas. We're essentially one of the biggest app development builders in the nation. We do, I think, a lot of good work, built over 450 experiences over the years, mobile, web, those types of things. My background had been in commerce and some startup work. I've helped a lot of startups get off the ground, but in bumping into some movers and shakers when I moved back to Dallas from New York, I met a brother named Benjamin Vann. I was referred to him because he had an incubator at the time and essentially an accelerator to move startups forward. And I had to know this guy's name. I had to get in contact with him. We finally ended up meeting up at Good Work, and honestly, I've been tracking him ever since. So, BJ, can you give a little bit of your background and just talk a little bit about yourself and Impact Ventures for a second? I can't hear you.
There we go. I think I'm off mute now.
You're good.
Well, definitely thank you, Al, for facilitating this conversation and creating this platform. So I'm excited to be here and speak with you all and hopefully add some value to everything you've been learning today. I got a chance to sit and watch with the other panelists in the sessions before. And so looking forward to diving into the discussion. So as Al has said, my background spends about 13 years in the financial sector. I also worked in philanthropy, micro lending, and dabbled in entrepreneurship and social entrepreneurship as well. And so I come from a non-traditional background that led up to, I guess you could say, the venture startup industry. And so currently I am the CEO of an organization called Impact Ventures, and we are an organization with a mission to eliminate the social and economic barriers for women and entrepreneurs of color, building high growth companies and social enterprises. And over the past 3 years, we've worked with some of your top global brands and corporations, major foundations, to accelerate over 115 startups. We impacted over 2,800 people here locally in the DFW area, and are excited to really embark on the next phase, which is building an integrated capital fund. And so excited to just share some of my experience and knowledge around what I've seen in the startup community, and maybe give some definitions of startup and the intent behind what you're looking for those of you out there that are looking to raise capital. And so that's just a brief little bit about my background.
Sure. Let's kind of cut through some of the mud a little bit. When it comes to venture funding and capital raises and those types of things, I think it starts to get confusing, but let's see if we can break that apart a little bit. There are companies like Backstage Capital, Harlem Capital, who actually provide finances. And then you've got more preparatory companies like Founder Gym on the other side of the spectrum. Where does Impact Ventures fall in actually funding as opposed to making sure you're prepared to go and seek funding? Where do you fit?
Right. So we definitely have to say we fit right in between. So we're a combination of the preparatory, what you call like a business support organization or BSO. These are organizations that support entrepreneurs with training, development, access to mentorship. They facilitate capital. And we're kind of in that middle piece. We actually start and look at the stage around product market fit instead of just the fundraising. So we actually look at how the startup is doing their customer acquisition, how they're legally structured, how they're looking at their business model, really the nuts and bolts of running and building a startup versus focusing just on that capital raise component.
Sure, interesting. So, and I know the spectrum is vast. Let's kind of keep focused to the capital raise because I think that's the sexiest and one of the most interesting probably to the people that have tuned in. When it comes to capital raising, when I've been out bootstrapping a startup, I've gotten it coded and it's maybe in market, or I just have an idea. When is a good time to go and seek funding? And when should I go out and prepare a pitch deck and try to ask someone to join this ride with me financially?
Definitely. So I kind of asked two different questions there. When should you go raise and when you should go out and ask people to join you? So I would say on the ask people to join you, I would say do that right away. Building that strong team is foundational to raising capital. I also say the right time to raise capital is really, it depends. You've seen startups get funded with an idea on a napkin. And then you've seen startups get funding, once they hit, 1 million, ARR, right? So
if you're getting funded with an idea on the napkin, I have not seen that with anyone else. So I need you to clarify that.
Yeah.
How early can you actually get, how early can we actually get started?
Right. So when you say we, that's the kicker right there. So when you talk about funding Black-owned businesses and people of color specifically, we have to first acknowledge what are those barriers in place in the industry that we've been excluded from. And so, of course, that doesn't happen as normal and as usual in the space. But let me back up a little bit when you talk about like capital raising and before you even get there is first even understanding like what type of capital you should be raising, right? And so the part of knowing when is knowing what, right? And a part of knowing what is knowing what is your intent in your business. So I like to define a startup as an entity in search of a business model, right? And I say startup because people have different definitions of startup. It could be a startup could signify the stage in the company or maturity in the company, but then it also could define the type of business model, right? And when we say business model, I mean a high growth, one that's built for scale, right? And then you have your lifestyle, more low growth or slow growth businesses that are more small businesses, right? And so a startup, when you talk about getting to product market fit, a startup doesn't necessarily, it shouldn't have a ready-made business model, right? If it is, it's probably a small business. Mm-hmm. So if you're running a small business, you're opening up a donut shop or a barber shop, you know who your customer is, you know what the business model looks like. There might be some iterations and innovations built around that. But when companies like Uber or Lyft or Airbnb and these companies came out, there was no business model that was already in existence for that. In a way, we can say that, but there's iteration. You can say hotels are basically that. But in a way, we didn't know that strangers were going to feel comfortable in sleeping and getting in other people's vehicles, right? And so the startup, et cetera, is around like, okay, do you have an entity that's in search of a reputable business model? Once you can do that, then I think you can really talk about funding. And when you talk about funding, knowing that, okay, if you're doing a high growth business, so if you're looking for venture-backed companies, right, you have to know, is your idea even big enough for a venture investor, whether that be angel or whether that be a VC or institutional investor to even want to invest in that company, right? Is the idea big enough? Is the problem you're solving big enough that's worth venture investment, right? I'm probably going a little bit too ahead, but I'll stop right there.
No, I think it's fair because I think the one thing I think is interesting is what are the differences between angel, pre-seed. You got your uncles that give cash all the way to the pre-seed and seed and series A, B, C. What are the differences and why should people care, right? Because I might need $150,000 to complete a prototype or round it out. I might need $1 million to staff up to service a warehouse or something like that, depending on my business. So how do I know what those phases are and how they'll help me as a business?
Definitely. So obviously your earlier stages, your pre-seed, your anything that's before your Series A, which is your first priced round, meaning equity round, meaning you're actually filing a regulation D with the SEC to actually be able to legally issue shares publicly or even privately. That is anything before that is called either pre-seed or seed, right? And understanding what stage you are, there's a number of factors that go into it. It could be how developed your team is. It could be how developed your your product is. You know, if your product is a prototype or your product is an MVP, that's a big difference between the two, right? Even understanding your market, maybe you haven't sized your market yet, so you don't quite know how much your company you could really grow big enough to be in terms of valuation. There's a number of factors that go into identifying what stage you're at, but I think it's important to attach your stage of company and what you're investing based on what you can execute, right? And so the difference between going from enterprise, which is like your, let's say, Capital One, or let's say, you know, your Fortune 500, your enterprise level company, and then you got your, let's say, your middle market, lower middle market. Then you got your small business, which most people don't know. Small business is really at $1 million in revenue or below. And then you got your micro business that's really about 250 and below, right? So you got micro enterprise, you got small business, which is really anything under $1 million. Anything from $1 million to about 5 is kind of like lower middle. Then you got your middle, which is like 5 to 20 million, and et cetera, et cetera. But
so let's do this then. This is starting to break these pieces down. You said something a second ago I think is worth mentioning. Market size and MVP, two totally different things.
Yep.
Once and for all, can we get a definition for MVP? I got an idea, Bottle Rocket has an idea, but let's hit everybody with the true definition of it.
True?
Or
I'll give you mine.
Yeah, there you go.
Right. You have yours. I'll give you mine. So an MVP is what it stands for, minimum viable product, right? So this is the minimal iteration or products that you can put in the market that actually feasibly does what your intent is to do with your company, right? That's the minimal without the bells and whistles. You know, you might want to launch a product in several different markets and have several different features, but at the same time, what is the core feature of what you're building, and what's the minimal viable product that takes the less resources to be able to produce a product?
Wow. All right. Look, here's this matters, and I think founders need to hear this, and people need to hear this that build software and ask people to build software. A minimally viable product it's without bells and whistles. We're going to avoid those bells and whistles. You said something that was interesting called it. You said intent. We actually at Bottle Rocket, we like to call that a hypothesis. You have to have a hypothesis of a problem you want to solve, how you want to address it, what you think the outcomes are going to be before you try to build an MVP. Otherwise, it's just software. So spend some time on how intricate you can go with an MVP for it to launch. It doesn't have to be perfect. It just needs to make the point. Can we go there for a second?
So we can see it in a number of existing companies out there today. You know, examples of an MVP, they don't have to be pretty. As a matter of fact, they prefer that an MVP be the ugliest version, to say, like, if you aren't embarrassed by your MVP, then what's the saying? Either you're too early, or what is it?
Or you launched too late.
Yeah, or you're too late, right?
Yeah.
And that MVP is really based on what can you as a founder sell at the minimal. So if I can, what they call delight, if I can delight a customer with a shoestring budget, what could I do if I actually had that pre-seed or that seed or that Series A capital, right? And that really is puts the onus back on the founder. Which, when you're talking about anything pre-Series A, it's a weighted average, I guess you could say. But the most important component of early stage companies, startup companies, is the team and the founder, right? Are you the right founder? Do you have the right background, expertise, skills, knowledge to execute what you're trying to do, right? Can you effectively sell, inspire, and build a team, which you can't pay them $80,000 to develop a product, right? That is the core. Your core focus at the early stage is are you the right person, right? And so that's kind of really the key in going into your MVP, and understanding that your MVP is only designed to get feedback and validation from the market. Like, your MVP is not supposed to be used to be built at scale or be a final
product market fit. That's not the job of an MVP. You know, I really wish more founders would take that heed. It actually is a self-fulfilling prophecy for you to go in with a I see written in the comments here, a risky hypothesis for you to go in, bootstrap as much as you can, something that goes into the market. And yes, it's going to be embarrassing. So what? But I think entrepreneurship is reserved for those who can take that perceived embarrassment. But for the most part, you're in market. And that's what the press
Right.
can say, right? That's what you're, in fact, you can design the press. You've got press releases, you can release, you can build your own narrative.
You can create your own narrative, yeah.
Absolutely. But build something, get it in market, and then in the background, be planning how you can get it, upgraded. And in fact, you can't upgrade anything until you hear from your market, until you hear from the users, right? So you can out product manage your users very early on.
And I'll say, Al, one of the top reasons, the top two reasons that startups fail, right, is one, because they run out of money, right? They typically don't plan. They don't actually know what the runway is, right? Or they don't have any capital to begin with. Mm-hmm. The second reason, and those can be intertwined on which one is first or second. The second reason is because they fail to define and find the customer, right? And a lot of times what I see with entrepreneurs, especially entrepreneurs that look like us in our community, is that we avoid the dirty work of getting in the weeds of the customer. We launch, we have a hypothesis that we believe, and we focus on the solution instead of focusing on the problem, right? And so because of that, we end up solving the wrong problems, right? That don't fit that customer. We don't pay attention to what our customers are saying, right? Because we have no means to track that.
Or feedback loop. Yeah, you don't.
Right. Or a feedback loop to be able to
track.
Those
are more important than finished software, to be totally honest. Analytics.
Right. And a lot of that, it stems back to education and institutional knowledge. And this is why incubators and accelerators and programs like this that teach that institutional knowledge are important, because not every founder comes from a background working at Bottle Rocket. Not every founder comes from a former private equity, analyst that understands the venture game, right? So there's a level of institutional knowledge and a knowledge gap that has to be addressed, as you're building and scaling these companies, right? And the truth is that the CEO at Series A might not be the CEO that leads the company to an exit, right? You might not have the skills necessary to lead a company to an exit, but you can get it to Series A or Series B, right? And so the whole premise around startup versus small businesses, you can't be too attached, right? So if you're out there and you want to be in the startup game, like Al will tell you as a product person, he probably has 1,000 projects that he hasn't picked up yet because they've just been sitting on the table waiting, right? I'm probably right? Yep. Developers, they build things, right? Because you can't be too attached to an entity or a product that's meant to scale and sell. So you have to understand the intent of what you're doing in this particular industry. Now, if you're looking for something you want to pass down to your family and more legacy building, that's a different type of business.
Sure. I'm gonna bridge the gap between MVP and market size, because you talked about that earlier. TAM, SAM, SOM, right? The total addressable market. That's everyone in your industry spending money. Then there is your serviceable market. Who can you actually touch? Like what are the segments? And then there is, essentially the SOM model, where how can I actually obtain this person? How can I get to $10 million in a year, annum, right? Because your ARR is going to be important if you go in front of any investor, or at least your trend towards it. That's the sweet spot, by the way, like 10 million. The investors, you can talk a second ago. You can talk in a second about what the investors are going to be looking for. But let's talk about the MVP. Is it in place to service the SOM, the SAM, or the TAM?
I would say your MVP, I would say it depends, right? It depends, but I would also say your MVP can be used to address everyone, right? Because that's who you're getting feedback from. Mm-hmm. And I think as you do that customer discovery using that MVP, you start to narrow down who your actual focus and your target audience is, and your target client or segment, right? And then when you're going after that SOM, which is basically what you can actually execute, like what you have the resources for, mm-hmm. what your team can go after, Those all depend on your go-to-market strategy, right? So if you want to go to market with, and you want to get 10x, or 10 million, in a year, your go-to-market strategy is going to look very different than someone who's not trying to grow that fast and doesn't have a product that can sustain that. So it really depends, because you might have an MVP that can withstand 1 million users, right? And so if you don't have the infrastructure for that product, then you can't go after the larger market. So I'd say it depends.
That's right. And so in pitches, we do a lot of due diligence work, and I did beforehand, where we would go to private equity, sit in on some of these meetings where a founder would be pitching, and they would talk about TAM and almost get laughed out of the room, right? When you're building something for 250 million people initially, when you haven't built it for 5,000 people
right
in your area. So if you're looking for cash and you're looking for a dollar amount to help you with marketing or scaling or something like that, let's just make sure you have an idea of what the trajectory looks like, who can I obtain, who can I actually service, and then what the total market looks like. Let's just make sure we keep people grounded. And investors want you to speak the language of segmentation. They want you to know the difference between the total market and exactly who you want to reach. So I want to make sure the audience kind of understands that part too. How important is knowing customer acquisition costs? Because that's another thing people get laughed out of the room for in the meetings.
Definitely. So your customer acquisition costs, from a funding perspective, from an investment perspective, tells the investor how much money you're burning, basically, in a way. It's not your burn rate, but it can be telling around how much money you're burning within the startup. What are your profit margins, right? So if I'll put this in simple terms, but if you're selling fish for $5, right, and it costs you $3 to make it, right, your profit is $2. And so the idea around running a venture-backed company is, how do you squeeze down that $2, that margin, or that $3 margin, your cost, to get a obviously larger income or larger revenue within the startup, but then it also affects your ability to have an evaluation that's actually accurate as well, accurate and even worth it for an investor to come in. Because if you run a startup in which your cost of goods sold, whatever that is, that looks different in startup than it does in a traditional business. But if your cost is not at a rate that seems either profitable or can drive your valuation, right? And we'll talk deeper into that, because valuation is all not about revenue. Intellectual property or IP is really tied to the valuation of a company, a user base, et cetera. There's a number of factors that go into that, but you have to be conscious of your costs. And so when a founder says they want to raise capital, and we were talking about this yesterday, about how we're fascinated with the raise, right? But we haven't yet become tenacious about the exit. You ask them about the raise, but it's like, okay, if you get that $1 million raise, what's next? Like that's not the success. That's the beginning. That's right. Now you have to put that capital to work. So your capital should always be tied to growth metrics. Right.
You got bosses, and now you got stakeholders. Now you essentially have a new job once you take on investment. I mean, but depending on how you write your term sheet and what your board looks like after a raise, can really determine how much control and who you're actually working for afterwards. Because I've seen it flip quite a few times. You get so anxious.
Founders get outed, yeah.
Absolutely. Can you talk about that anxiety after a raise? Because we've going through Founder Gym. I was a part of Founder Gym. There's a lot of people actually getting raises. Shout out to Founder Gym and the entire staff over there, by the way. But I love what Impact Ventures is bringing to the table now too, because people are actually starting to get funding. They're starting to get raises. So what can you look forward to once you get that number?
So what can you look forward to? That's an interesting way to put it. Once you get the money, what can you look forward to? You can look forward to working about 10 times as harder as you did before you got capital. Right. That's what you can look forward to. But I will say, with getting capital, and not all good capital is good capital. Some money is dumb money. And so you want to make sure that you're taking money that's also a value add, because the value add money is also going to help you with that execution strategy, right? So it's one thing to get $1 million if you're working in the, let's say you're working in the marketing and media industry, from an investment firm that has relationships and has business development relationships in the industry that you're in, it makes that process a bit easier when you have an advocate, right? Because your success is tied to theirs. So they're going to be more susceptible to helping you, right? And not just letting you sink or swim with the capital because they're invested in your success. So understanding who you're taking capital from is important. And also understanding what does your use of funds plan look like? So that capital should be leveraged for growth, right? So because you raise $1 million doesn't mean, okay, now I get to pay myself $100,000, right? Now I get to get that 6-figure salary that I've always wanted, or upgrade, to the house that I've always wanted. And we've seen founders do this, right? And so it's really about being as lean, right? You've heard of the lean startup methodology. There's a purpose behind that, because you want to be able to, the goal is to get to the highest valuation, right? In the shortest amount of time, without spending the minimal of resources, to do that, right? Mm-hmm. And so getting that capital is just the beginning.
I saw very recently, these are the things that inspire me. Zoox was acquired by Amazon. It was a self-driving car company, African-American female or woman founder. That's an exit. That's a liquidation event. The acquisitions, that's when you pay back your stakeholders and shareholders along the way. It's not getting the raises. No one actually gets cash, for that. Your shareholders don't get cash for that. It's when you have a liquidation event. What are the differences between liquidation events and just another round of raise? Because we tend to get excited when we see a raise.
Yeah,
and that's good news. But how important is a liquidation event?
Yeah. So the liquidation is the end, right? And the capital raise is the means to the end, right? And so, yes, it's important to raise capital. We've seen companies exit and never raise a dime, right? Because they had strong market fit, they've had strong revenue, they've had strong growth trajectory, that they've been able to prove that hypothesis out, right? And then we've seen some companies that have raised a lot of money and they were never able to find product market fit and get to an exit, right? And so understanding that exit, there's different types of liquidity events, right? So when you talk about IPO, is your company big enough, or is the problem you're solving big enough to even be an IPO venture-backed company, right? And that's an initial public offering. That's basically your Netflix, your when you can be publicly traded on the stock market, right? You have structured exits. So you can go into a business and already have a structured liquidity partner that says, I'll buy your company when you get to X metric, benchmark. When you get to $10 million ARR, this company will acquire you, right? There's tons of different types of liquidity events that come into play. But I think as a community, we should put less emphasis on the raise. The raise is more of a signal, right? It's a signal to other investors. It's a signal to consumers. And it really says there's something here of value that someone's taking an interest. That's all it says, that there is interest, right? That's all it says. Doesn't mean success. Doesn't mean that company's profitable. I mean, companies like Uber and all these different types of grocery delivery service, none of them are profitable, right? But they've raised millions of dollars, So the raise is one component, which is important if you're trying to grow fast, right? Remember, capital raises should be tied to growth metrics. And so getting to that exit, though, I like to say that small businesses create income and build jobs for local communities, but tech startups and high growth startups build wealth. And so if you're in the game of building wealth, then understanding that the liquidity event is essential to building wealth. Look at Silicon Valley. Half of those guys that did exits, what they do as soon as they got their exit, they bought real estate. So the same guys that were the tech giants are now the real estate owners. So they built wealth, they bought assets, things that accumulate, right? Not just paid themselves, $300,000 a year, but when they got to an exit, right? And understanding the exit is key. Look at what are some larger companies in the market that have a history of buying up smaller companies that are creeping into their scope, right? it takes a lot of research, right? And understanding what is the likelihood of you getting to a liquidity event, right? Is it selling to a competitor, right? Because you have a proprietary technology that would allow their company to benefit, right? And so it's really about understanding your competitors' markets, understanding your market, and where you fit in between. But 100% the liquidity is the golden ticket, is the treasure at the end of the rainbow, right?
That's a piece that we don't talk enough about. We talk about the raises, and a lot of these popular companies talk about that piece too. But the end game is not the raise. Essentially, that's just helping you along the way. We talked about financing kind of being the difference between small business and startup. Just so the questions don't get too locked up over here, I'm going to start asking a couple of them while we talk. What's the difference between a startup and a small business? You gave an answer earlier. It was a little early in the conversation, and just in case somebody missed it, what's the difference between small business and startup?
Yeah, so it's really focusing on the business model. A small business and a startup, a high growth startup, can go after the same types of capital. They can go after equity capital. They can go after debt, which are loans, term loans, et cetera. They can all go after the same type of capital, but it's really focused on two things. That's the business model, which is it built to scale or is this built to grow, right? Over long term. So is it long term or is it short term? Once you understand that, then you can look at the types of capital you should be looking for. So small businesses tend to look for slow, low growth types of capital. We call it patient capital, right? That could be a term loan, it could be SBA loan, it could be revenue financing, it could be structured financing, it could be royalty financing, it could be dividends, quarterly dividends, it could be a number of sources of different types of debt capital. We see in other industries, for example, like let's use like the trucking industry. That's our community. We have a lot of business in the beauty, health, the food services, but also in the AEC, which is like architecture, construction, and engineering space for Black-owned businesses. A trucking company, even though it is a small business, it does have the ability to scale. Maybe not venture scale. For example, can you get a trucking company to expand to China in less than a year? Probably not, but a tech company, you could probably do that. But in a year, you can service the whole Southeast, right, with the trucking company, right? So there might be a component of equity if you want to scale that company. Maybe that company acquires a smaller fleet, right, and is able to expand that way. So there's models that are built for small business to be able to grow and where they might need a sliver of equity. What we look at differently in terms of the traditional venture industry is looking at integrated capital and looking at the entrepreneur's capital stack. And so that's the philosophy that I take on investing, where I feel like our transition from this like hyper like venture capital industry is moving towards is more of an integrated capital strategy, meaning like how do Black and brown founders get the type of capital that's non-dilutive, non-predatory, and allow them to grow through the life of their startup, right? Keeps them in a healthy equity space in their company and allows them to build wealth for themselves and their communities, right? That is a component that we are missing when we are recreating a system that was never built and meant for us. So the premise of capitalism is taking from the resources from one community, right, and basically smothering those to build for another. I don't think that is our nature as a community, and that's not what allows us to. That's not the way we've done business in the past. I mean, we could take it all the way back to the village days and how we did business. It's always been cooperative economics. It's always been our version of crowdfunding. It's always been our version of profit sharing, right? Some of the things that you see the Asian community go out when one store owner wants to buy equipment, instead of buying it one at a time, they'll all pitch in and buy bulk, right, to get what they need. That's stuff that we've been doing forever, right? We've lost that way, and there's been barriers and structures put into place for us to no longer make that important. But I feel like we're going back to those elements that really make business a core of who we are as a people. And so I really feel like that is the trajectory that the industry itself is moving in. I see a lot of, Black-led venture firms, and that's great. We need more of us. We need more representation, but understand the difference between representation and equity, right?
Yeah.
And so representation that says I'm a Black VC, I'm a Black investor, and I'm basically replicating the same model that we see white investors making, right? Mm-hmm. That's representation, right? Equity says I'm a Black founder and I'm investing in Black-owned businesses or Black and brown businesses.
Right. That's the next step. We applaud anyone that's able to, raise a fund. I think Harlem Capital.
Oh yeah, it's hard.
It's tough, and along with that come covenants, right? So those investors who actually pooled that cash, they're looking for 10 things, 11 things, right? So they've got to fill that quota. So if the fund doesn't come along with freedom to invest in those types of businesses, then you end up just being a Black-owned firm that right. doesn't actually service it. And I'm not saying that about Harlem Capital per se.
No, we need both, right?
Absolutely. Speaking of Black-owned firms, shout out to Founder Gems. Pierre Laguerre, he has a startup called Fleeting that just got a capital raise from a
just heard about that, yeah,
outsourcing platform. So shout out there. So the money's coming in, the funds are available. I think that the young folks are saying the bag is available. People that type of thing. So cash is available, especially now.
Right.
I have to speak to recent social unrest, but there's definitely now more of an appetite to solve some problems and be a proxy for some of that goodwill. I don't mind at all that cash landing in our community for whatever the means is or the reason why. We just want to see us perform and have the resources to do that. I'm going to ask you a quick question that came in from the group, and then we'll get into product management, which is a favorite of mine. What if a startup is purpose-driven, has a solid audience, and is solving a deep-rooted problem, but isn't selling a tangible product, so the valuation is tough to determine upfront? There's a few answers to this one, but I'd love to hear your thoughts on it.
Yeah. Startup, but isn't selling a tangible product.
Yeah, this feels like a goodwill play. They're doing something for a community. It has a purpose. Maybe there's some social responsibility as a part of it. There's definitely a few angles there.
So my question back, just as a clarity question, would be, is this a service model or is this a true startup? Because when you say if a startup's purpose is purpose driven, but it's not selling a tangible product, right? Is it a software as a service versus a tangible, a product, or is it a service model where the person is going out and doing the consulting? That would be my clarifying question to be able to give a better answer because it.
No, go ahead.
Yeah, I mean, it sounds like if you're not selling a tangible product, the only other business that would be is a service related, where you're performing a service versus a product, whether that product be, this cup here or a software, it's still a product. But yes, I would say the valuation, it could be both. Okay, software for now. Let's say software for now. Valuations are tough to even talk about at such an early stage. So I would challenge founders to think more about execution than they do about evaluation. We have companies that come through our program and say, well, my company's valued at 1.2. And it's like, well, but you don't have a customer. So
we're an investor to have set that cap table.
Or an investor, like, is this like a 409A evaluation that you've done? Or is this something that you said, well, we think, and we've done a comparison, the simplest form of evaluation could be comparing your company to a similar company in a different market, right? And say, okay, well, they're worth that, so we should be about the same.
Right.
Yes and no. Valuations are always, in the gray. So, but I definitely think that in terms of the question that she particularly asked, I think focus should be more on execution. And valuation is really going to be determined on if it's not a product and say it's software, then it's like, what is that software? Is there some type of IP?
Is it a subscription? I mean, like I'm definitely confused about the
yeah.
One thing I would question back, and we don't have to dig too deep. I see things like deep-rooted problem, purpose-driven. It feels like you're avoiding revenue, like you're avoiding saying the word revenue or early stage or something like that. So I'm going to say it's leaning more towards social responsibility. If we're leaning towards social responsibility, I would love to see more of a donation, crowdfunding, crowdsourcing type situation than any kind of capital raises where there's a valuation involved. Because along with that valuation, they're going to want 7x, 11x returns on it in a few years or something like that. So I didn't see revenue in here, and I didn't,
or look at different sources of capital in terms of, you're talking about purpose driven, which is kind of like my sweet spot in the impact investing space. You might want to look at different types of investors. So look at private foundations, public foundations, look at DAFs, which are donor advised funds. They can do things that other companies can't. And that other foundations can't, where they're prioritize the impact or the purpose or the problem you're serving. They prioritize that over the financial return. So, for example, I might take a $1 million investment, from a foundation that's really deeply concerned about, are you solving the problem? And so their return, or that whatever covenant that comes upon getting that capital, it might be, we only want 1%. We only want 2%, right? Because that particular type of source of capital, which is impact investing or this foundation, they're concerned with a different metric. Their metric of success is not 10x, 7x, right? Their metric for success is, did you serve 1 million people? Did you scale this to serve, another country, et cetera? So if you're out there and you're running a purpose-driven startup, think about it in that terms of flipping the prioritizing the impact over the financial returns.
That's huge, man. Fascinating answer, by the way. I took it a totally different way, but thank you for that, because that actually lines up exactly with what impact is about. It's not, valuation isn't about hard money per se. The valuation is about total impact. So that's insightful. Thank you for that.
Sandra had a great question in there. I thought that was good.
What do we got here? So when a company like Carol's Daughter either sells or is bought out by a larger mainstream company, is that a necessary step for growth? Many people see it as no longer being Black owned, even though they may stay on with the creative marketing. Is it better? Oh, this is interesting. Is it better that they stay Black owned even if they stay smaller? I'm gonna start with this one, and then we can get a more civilized answer from BJ. You got to remember those companies are themselves African American owned, right? So I lived in Bed-Stuy. In order for me to go into the office every day, I had to go through Fort Greene. That's where Carol's Daughter's headquarters were, at least the first location. I passed by it all the time, and I was happy for them when they had a liquidation event, when they were, I think Will and Jada were involved at some point early on, and then there was an acquisition, and then there was another kind of a merger or something like that. But I was happy for the company. They'll go on to do other things and may start a fund and may do another idea, may actually take it to another level. So I think I understand the urge to continue the legacy of those larger brands, but we got to think about the families and what type of legacy that they have access to with that liquidation event. There's other causes that they could fight and make impacts with. So I want to be happy for them. I'll put it that way.
That's a great point, and you definitely have more context to this particular business. But I'll speak more generally in terms of just the industry. You first have to remember that if you're running a business and you're the CEO, you have the right to do what you want with your business, right? So you have the right to sell, you have the right to not to sell. I think from a public standpoint or from a moral standpoint, there is a social responsibility, right? When you become a CEO of a large company that serves and impacts a large demographic of people, because now the people, they become not just your consumers, but they become your disciples, right? I'll use Tristan Walker for an example. When you buy your first razor, you're telling your boy about it. Like, you become disciple. Now you're evangelizing this company because it's Black owned, right? At the end of the day, he has the right to do whatever he wants with his privately owned business. Now,
you can't. You're being mean spirited with it, man. Like,
no. I'm saying that what she asked, was it a necessary step for growth? And so it's not necessary, but you have to think and sometimes in their mind, there could be a bigger play at hand that us as a consumer, we're not aware of, right? And so it could be, hey, I sold this company, but I took that money and I built an even bigger Black owned enterprise, right? And so I think we can't be as narrow-minded or put our individual expectations on people, because at the end of the day, they're people, and it's their business, it's their right. I think we should keep things Black owned, but I also know that change is inevitable, right? There's always going to be shifts. The market, there's always going to be new people coming into your market, right? Nothing is ever going to stay the same. If you think that someone's not going to try to come in and develop the next best product that you've held a market for, for a certain amount of time, you have to always be, as a CEO, you always have to have the ability. Great founders have the ability to see ahead and around the corner, right? And so my perspective on that is like, yes, it's unfortunate if they end up selling, and we don't know the deals of what that sale looks like. He could still retain, minority ownership, et cetera. But I think we just have to be happy for each other within just on a macro level. I think we should be proud of each other that, hey, that man just created wealth for his family, you know what I mean? And his community and whoever else was an investor at that time, which is why I'm happy to see things like what Don is doing, Don Dickinson's with Popcorn. I'm happy to see things like Angela Bilton, what she's doing. And these individuals could go out and raise $1 million on their own. But instead, they're saying, no, I want my community to benefit from what I'm building, and doing that. That equity crowdfunding round gives us the ability to participate. You know what I mean? And I think that's what we should carry with us as these industries grow, as innovation grows, as technology grows, as capital evolves. Is we don't have the luxury of growing without thinking about reaching back.
Absolutely.
Right. Other people have that luxury, but we don't. When we're first generation college students or college graduates, all of us are still the first to do stuff in our family. Like, think about Jim Crow was in our parents' generation. It wasn't too far ago. And so I think we don't have that luxury of building, or climbing without, picking someone behind us. And so I think we have to carry that seed with us as we continue to grow and evolve.
Thank you for that, man. One final point on the Carol's Daughter deal, and very similar for other deals. We talked earlier about having new bosses once you take on rounds of funding. What that translates to, sometimes your stakeholders want that equity event. Sometimes they want to have a liquidation event so they can get returns against the investments that they've made. Remember, when you're a CEO of a small company, you are the primary shareholder. Obviously, your employees are, and even your customers per se. But once you advance to the level of Carol's Daughter, they were playing in the leagues with L'Oreal and getting placement in retail malls and those types
different
of
game, yeah.
They now have the responsibility and covenants to their shareholders to continue to maximize potential profits. And we're going to talk about this in the enterprise discussion in a second, or return some kind of liquidation event to make good on the investments that have been made up previous to that point. And again, Will Smith and Jada Pinkett were involved at some point, so we gotta love them getting their money back. I mean, that's got to be a good thing too, right? One thing I wanted to talk about is a language system that I don't hear often when I work with startups and when I speak and talk to young folks. One of the things I'd love to start hearing more about is product management. The value of, first of all, the term, and then the practice, and then the pattern of product management. Can you talk a little bit about where you've seen the difference being made in just understanding what product is, product growth, product management, and those types of things?
Yeah. So I'll speak. You're the product expert. My wheelhouse is on the funding.
Chris Vestito is the product expert. I'm a fan.
But I will say, through technology and where we're at as an economy, there hasn't been a more lower barrier of entry to get into entrepreneurship. And I say that because earlier we talked a little bit about experience and understanding that our founders, Black founders, don't come from a technology background, right? You can trace those inequities all the way back to inner city schools not having access to computer science courses, right? I think the stat is like 12% of public schools, inner city schools, have access to quality computer science. That is a stat that stems and grows throughout the life cycle of when they get to high school, when they get to college, when they get to adulthood and they pursue a technology career. So that is a deep stat that other folks that I know that are in my network, Felicia Hatcher that was on earlier, that are working on that issue. That's a workforce issue, but that's also an experience issue where, and that's a lot of times where you see a lot of former tech people become tech founders, right? Because they understand product. And if you're a non-technical founder, which is the term, these are non-product focused folks, I would say it would behoove you not to study product management, at least the process. You might not know how to build it, but at least understand the process. Because if you understand the process, you know what it takes to build it, you know what it costs to build it, you know how long it takes to build it, right? Those are all things that go into being a project manager that have nothing to do with coding, right? They have nothing to do with doing a single code language, right? But everything to do with managing the process, right? And as a CEO, you have to manage process. You have to manage costs. You have to manage timelines, right? Because you have to be able to meet those deadlines and those timelines for investors, for stakeholders, for customers, for clients, et cetera. So if you're going to play in this space, understand product management and understanding the value of that process, because understanding that process, it's going to make your developers have less of a headache, right? Because they know that you understand what they're going through. If you've worked in any shops, I worked in the financial sector, but I also worked some time in the financial sector that was particularly in the technology realm of Fidelity, where basically the financial tech people were basically funding and doing the cost analysis for new software, because they do all in-house technology. They didn't do outsourcing.
Sure.
So a lot of times those conversations between product managers, the developers, and the finance folks, they're all speaking different languages, right? The finance folks have said, we ain't got enough money to complete this project. The manager's saying, hey, we got deadlines. And the developers are saying, look, this code is broken. We need more time.
Absolutely.
What do you want us to do? And so if you can speak the language of all three from a process standpoint, I think it'll take you further as a founder when you talk to other developers and bring them on your team. It'll take you further when you talk to investors because they know that you understand the product life cycle, right? And so when you're going to an investor and you can say, hey, we're looking for $1 million, that's going to allow us to complete phase 3 of this product. And you can tell them what phase 3 includes. The investor doesn't need to know what the code language is or, if you're, what you're using, but they need to know that you understand the process and you understand the timeline. So that's my spiel on product management and how important it is for our community to really be students of the game when it comes to that, because the cost and the barrier to entry is much lower. If you think about, I'm a big student of history. If you look at all the industrial revolutions, right? We're in the 4th, maybe even the 5th now with IoT. The cost, right? All I need now is a cell phone, you know what I mean? A laptop and Starbucks. And if there's any Black-owned coffee spaces out there, I'll be there to run a business, right? To run a startup. And so with that being said, you have to understand the product. You have to understand at least the process of it.
One of the things that I tell the founders that I invest in, I need to hear product language every time we talk. There's nothing more important than product. In fact, there's a lot of investors now that are talking to founders and saying, if you're a CEO and you're not a full-time raiser, then don't even try to do it. I tend to disagree with that. I think your customers and your product is the most important piece. If you please customers, you delight them, they keep coming back, you hit your RR numbers, you're approaching a good ARR. If you get enough good press around that, the investors will come. You'll have a dialogue. You don't have to be a full-time raiser. But one of the things I try to have every one of my founders do is a product service design. I want you to go in and do what's called service design, where you build out what your complete customer life cycle looks like. And what's really big in advertising and marketing right now is called CX. It's your consumer experience, and that's all the way through, from the consumer side to back of house to your warehouses, all the way down to the equipment. Every step along the way that your customers are going to experience and what actions that they do to trigger what's coming next. You want to design that entire process, period. And if you can't speak to that and draw a diagram to it, you don't need to go build any software. You're going to waste money. You don't need to go raise any cash. You're going to trip up over these conversations because there's going to be someone in the room from product that's going to ask these questions and figure those things out. So I would encourage you to go and look up a service design and a service blueprint and really figure those things out before you get started. And again, I'm a fan of the product space. I think you can't build good software without good product thinking, and you can't deliver good software without design. I missed the UX discussion a little earlier today. I really wanted to get to it. We had a meeting, but design is also something that's very important too. What in your experience has been the value of design and UX as it pertains to capital raises?
Yeah, man, it's key because it directly affects your ability to find product market fit, right? And so if you do not focus on the customer experience or the user experience, and when we say UX, I'm assuming, Al, when you say UX, you're not talking about like the web, like from a web standpoint. Yeah,
I'm talking about from holistic experience.
Right. And I just want to clarify for everyone out there, we're not talking about what your website looks like or your, any of that user design. We're talking about the designing of the experience is crucial because if you think of apps like, the difference between TikTok and let's say Snapchat, right? The experiences of the two are completely different. Let's look at Facebook and LinkedIn. Like the experience that a user has with all those different platforms are completely different. Mm-hmm. And so if your user experience isn't tied to the business model and how you're provoking spending dollars or acquisition, right? Or lifetime value, or looking at what are the metrics that show financial success of if your company is profitable or if it's making money, you cannot sell that vision to an investor. You cannot make an investor be convicted, by your hypothesis if you haven't figured out that your hypothesis is actually true. And how do you figure that out if it's true? By creating and designing every experience to where you're predicting and you're controlling every outcome, right? Because I know when my user comes to this, they're gonna think two things, right? They're gonna think this way or this way. I'm gonna design this process that automatically drives them this way. So creating that whole design process from acquisition, from newsletter sign up all the way to acquisition to download to the first hello, that all needs to be designed.
Absolutely.
In a way that ties back to
So right. It needs to feel intentional, even though to the customer it may feel organic and easy to use. Every single step needs to feel intentional. And this is to answer Sarah's question. How do you get your team started in product management? I can't think of a better resource than productschool.com. From a 10, 11, 12-year-old all the way up to, 50s, 60s, anyone that's inside of the product space, they're going to go there. And that's the language you'll want to be able to speak to get a raise later on. If he's acclimated to the product management language, he'll have no problem getting a raise in 5 years when he starts to build his first startup. Oh, we've got to go.
Bad. I feel bad that I've stepped into the frame now. This conversation seems like it could go on and on. I posted on IG that, any company or anybody that's watching this can give us 3%. Just go ahead and donate 3% to the Can Diversity Collective for this master class that we just shared with everybody for free. This was some really good stuff. So I thank you, Benjamin J. Vann. I think people should be in your DMs and inboxing you for information. Al Nolan, thank you so much for this great conversation. We're going to hear from you with another team of great tech people. Thank you for the insight that you guys provided. I feel more confident in my own ability to perhaps start my own company with my MVP.
That's right.
My MVP.
I know you got some ideas.
I got some ideas. So thank you guys. This was such a great panel. I'm so glad we had you talk to our crew today. Please, let's stay in touch. We're going to provide this recording to the masses for sure on that. We want everybody to stay tuned for our 3 o'clock session that's coming up. That's called From Startup to Enterprise. So this got you into the mode of thinking about how do you go get the money. Now I think they're going to talk you through the process after that, or I don't know, but
absolutely.
We have some great
where the real work starts, actually.
Okay, great. So you guys, thank you so much. Thank you, and thank you, Al. We will see you the next time.
All right.
Bye-bye.
Thanks.